JP Morgan Chase suggests that over the last 4 decades, the median or mean market share of precious metals and precious metals related securities relative to all other asset classes was 2%. Now it's 0.5%. So if gold gained enough favor merely to return to its average market share over the last 4 decades, demand for the stuff would grow fourfold.
This could be the best opportunity to get rich. I mean, as the dollar comes down and all fiat, fake money, the Japanese yen, the peso, the euro comes down, this could be the biggest opportunity you'll ever have to get rich quick.
Did you know that gold has increased in value by over 540% over the past half-century? This remarkable growth has made gold a popular choice for savvy investors looking to secure their financial future. Robert Kiyosaki is making headlines again, not for a market forecast, but for sharing a surprisingly simple wealth-building tip. The Rich Dad Poor Dad author, famous for his disdain for fiat currency and passion for hard assets, has now revealed the easiest path to becoming a millionaire by investing in gold. Market expert RickRule notes that under-owned precious metals are prevalent in today's investment landscape. Citing JP Morgan, RickRule notes that gold and silver should be 2% of U.S. portfolios. He suggests that even a simple reversion to historical norms could trigger a fourfold surge in demand. The gold price remains supported by a complex mix of dynamics, with ETF demand playing a key role in offsetting a sharp decline in traditional consumer demand. While higher prices have discouraged retail buying, potential Fed rate cuts, weak economic data, and geopolitical risk keep the safe haven gold's demand intact. From a technical perspective, Robert Kiyosaki recalls rejecting fake money after learning about Nixon and Johnson's removal of gold and silver from the U.S. monetary system. Moreover, RickRule supports Kiyosaki's views, noting that gold has compounded at 9% annually for over 25 years. He explains that gold helps you not get poor slowly, and suggests that silver, or even mining stocks, can offer higher returns in a true bull market. Kiyosaki and Rule cite past manipulation, pointing to JP Morgan and silver's vulnerability due to its small market size. Silver ranks among the top-performing commodities on the market, with renewed investor interest and strong fundamentals driving prices to their highest level in 14 years. According to a report by Sprott, silver has historically delivered roughly twice the gains of gold during past precious metals bull markets. This pattern highlights silver's explosive upside potential when momentum in the sector accelerates. Before we dive into RickRule and Robert Kiyosaki's sharp insights from their latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
I spend a lot of time in my declining years explaining, as you do, the efficacy of owning precious metals to young people. JP Morgan Chase, as an example, suggests precious metals comprise less than 0.5% of the total savings and investment assets of Americans, down, by the way, from a 4-decade mean of 2%. The first lesson there is that if the rest of the things we talk about for the rest of our interview come to pass, it is likely that the market share of gold at least reverts to mean or perhaps overshoots. I'd like your audience to first of all think about what a fourfold increase in demand would do to price. I'm not smart enough to give you the answer to that, but I leave it to you to use your imagination, understanding that prices are set on the delta between supply and demand. Imagine the potential impact of a fourfold increase, which is merely a reversion to mean.
If you ever wanted to get rich quick, don't miss this boat. Do you know what I mean? It's shoving off right now. And if you're still saving fiat or fake money, like I hate to say this being Japanese, Japanese, they save cash and they love cash. And I've always saved gold and silver. And I just, once I understood what Nixon was doing and what Johnson took the silver out of our coins, I said, why would you save fiat, fake money? And that was kind of my wake-up call. And I've gotten very rich just because I don't save cash. I save gold and silver. And that's the difference.
I think the demonstration of that isn't just this last year where gold has done well. People on shows like this for a long time asked me when gold was going to move, and I'd scratch my chin sagely, Robert,
Jeez.
and I'd say, well, I think gold's going to move in the year 2000. It's up 9% compounded for 25 years. Gold is two things. Gold is about not getting poor slowly, and if you're aggressive, and if you can afford to be aggressive in silver, which tends to outpace gold when a bull market really truly gets underway, and if you're willing to work hard and invest in the gold stocks or silver stocks, which tend to even outpace the metal, albeit with much greater risk and much greater volatility. What you say is very, very, very true. Anybody who looks at the graph of the XAU or any of the gold and silver indexes understands that when you move into a real precious metals bull market, the upside volatility is unlike almost any other financial market on the planet.
Well, it's exactly as you said. How do you get poor? Slowly at first and then suddenly? Well, it works the other way too. I hate to say this. I'm going to say something very sacrilegious, Rick. I sold 4.5 million in gold, but my basis cost was 300. Do you know what I mean?
Right.
And I paid cash for my house. So I walked into this house. I said, I'll take it. And my gold is stored in a place called Liechtenstein because I don't want to be in 1933 again where they take my gold.
Right.
So I just walked in and I said, so I paid 4.5 million. My basis is 450,000.
Right.
Just because of when I bought it. And your date is exactly correct. It was 2000. Do you know what I mean?
Hugely important lesson. One of the things I do is I maintain an alternative statement of account as a thought exercise, and I have since the year 2000, measuring my income, my net worth, and my expenses in both gold and dollars. And if you do that, what you're struck by is how cheap food is, how cheap gasoline is.
Yeah.
If you measure it in the golden constant, the price of gold was at $250, $255 an ounce in 2000. You're astonished by the difference in value between your gold savings and your dollar savings. My experience, Robert, is that precious metals bull markets are led by gold. They're led by physical gold, and they're led by fear buyers. They're led by people,
pessimists.
maybe pessimists, maybe not, just people who don't like the arithmetic of fiat currency denominated securities. I'm one of them.
Yeah, me too.
When the momentum in the bullion begins to expand the producer's margins, the big gold stocks move next. And we've seen that. Franco, Wheaton, Agnico Eagle, they've all doubled in 12 months. At some point in time, that movement, that momentum attracts the generalist investor into the gold space. And the gold space is so small, it can't accommodate the money. When that happens, leadership goes from gold to silver. And by the way, you will not need Robert Kiyosaki or RickRule to tell you when that happened. The end of the precious metals bull market is when the money trickles down into the junior miners and the junior producers. And those moves are truly insane. Playing it requires a lot of education. It requires a lot of discipline. I would suggest that probably 85% of the junior miners are valueless, but that 15%, they generate such robust performance that they had legitimacy and even luster to a very rough sector. You described the chain perfectly. Silver will come after when the generalist money comes out of the space. Our mutual friend, Doug Casey, described that event, the generalist money coming into the silver market, as attempting to siphon Hoover Dam through a garden hose. You know, people say that the markets are manipulated. All markets are manipulated. It's just that the silver market is so skinny that the potential penalty, I don't mean governmental penalty, I mean market penalty for manipulation is extremely high. I remember in the decade of the 70s when silver markets were manipulated up because that was the easiest way to manipulate them. And I suspect that trading desks will do that again. JP Morgan amongst them.
President Donald Trump's domestic spending measure will add more than $4 trillion to the national debt over 10 years, the nonpartisan Congressional Budget Office said this week. In June, the White House disputed concerns about the debt risk posed by Trump's spending measure. Rather, the Trump administration stated that the measure will reduce the nation's debt as a surge in economic growth fuels higher tax revenue. In his outlook, RickRule explains America's worsening financial position, noting that on balance, sheet liabilities now exceed 120% of GDP. With U.S. private net worth only slightly exceeding total government obligations, he warns of an inevitable currency devaluation, a dishonest default, and reaffirms that gold remains the ultimate protection when government debt becomes untrustworthy. With debt now reaching unsustainable levels, the role of gold has changed. It is no longer just a safe haven play or a crisis asset. It is now one of the preferred capital resources of some of the world's leading monetary authorities. Let's get back to the interview.
If you look at the other promise today, which is to say a U.S. dollar, literally, it used to be a package of dreams painted on a piece of paper. Now it's a packet of dreams clicked into existence. And it's really important, I think, that people know that. Not that the dollar will cease to function as a medium of exchange, but it's an increasingly inefficient medium of exchange if you also ask it to be a store of value, Robert, as you know, but many people don't. It's interesting that you talk about all other forms of exchange as debt, because I think for Americans, debt is the concept that will lead to the best understanding of gold. At the Rebel Capitalist Conference, Gorman's conference, I talked about the math of America. I talked about the fact that our on-balance sheet liabilities exceed $37 trillion, which is now, 120% of GDP? In 1982, to put a large number in context, on-balance sheet liabilities were only 32% of GDP. So we've gone from 32% of GDP to almost 130% of GDP.
So Rick, with all your experience, what does that mean to you? Like when somebody says it's 120% of GDP, and there was Rogoff, Reinhardt, and all that stuff, but the average American, you must be speaking Chinese right now.
The average American should read this wonderful Churchill quote. Not Churchill, I'm sorry, Hemingway quote. They were asked how he went broke when he had all that income. And he said, only at first, then all of a sudden. It's important for the average American to note, too, and almost none of them pay attention to this, that the bigger problem, rather than the on-balance sheet debt, is the net present value of unfunded entitlements. Look at you and I on the screen, Robert. We're poster boys for this. Medicare, Medicaid, military pension in your case, not mine, federal government pension. It is estimated by the Congressional Budget Office, not some cranky old libertarian, RickRule, but the Congressional Budget Office. It's estimated that the net present value of unfunded entitlement programs exceeds $100 trillion. Now, again, this number in 1982 was about 90% of GDP. Now this number is 350% of GDP. And the math gets a little worse, Robert. I really want your listeners, I know math is boring, but I want your listeners to listen to this. The IRS estimates that the private net worth, the aggregate private net worth of all Americans, is about $141 trillion. And if you add the on-balance sheet debt of the U.S. government with the unfunded off-balance sheet debt of the U.S. government, that number is 130 trillion. So you take what we're worth, 141, minus what we owe, 130, there's only 11 trillion left over. Now, how do we get out of this? What I figure we do is we preside over the devaluation of the U.S. currency. We have a dishonest default. And that's where gold comes in. Gold for decades, for millennium, has been a medium of exchange that's simultaneously a store of value. It's been a place that you go when you don't trust government debt. The math suggests that this is a wonderful time.
Heavy global debt loads can lead to widespread economic instability, currency devaluation, reduced private and public investment, and an increased risk of a global fiscal crisis. Gold also plays an established role in multi-asset strategies. For instance, Ray Dalio's all-weather portfolio allocates about 7.5% to gold. Robert Kiyosaki has been a vocal proponent of silver and gold for decades. In October 2023, Kiyosaki predicted, "Gold will soon break through $2,100 and then take off. You will wish you had bought gold below $2,000. Next stop gold, $3,700. As fiat currencies falter and debt mounts, are you prepared, or are you still trusting paper promises over real value? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.